Good evening, guys. Ken at Tortoise Capital with the nightly strategy podcast for April 13th, 2020. Stay off the beach, wash your hands. Do what your mom tells you. Come on. Okay, so this morning I had a chance to talk about our basic strategies on the Van Tharp Institute weekly podcast. And one of the central ideas I discussed was this idea of chain trading, and the idea that on any time frame we have the ability to start with the hybrid frogs, follow in the direction out of a critical state, in whichever direction price wants to take us. In this case, if it takes us down, and if this were intraday, we might take a hybrid frog entry, trail it with one of these minimum manageable risk boxes until we get a unambiguous move, which then terminates in a regression line crossover, a P1, and then crosses the dragon with an RLXT. That would be the third step in the owl. Then when the dragon and the RL90 roll up, it could lead to an owl, which would be a retracement back to the previous fair value up here. And that retracement might take the form of one or two legs. Ideally, it just goes straight back and then just keeps going. That would be the best of all possible worlds. That would look like a morning hook and go. But more normal behavior is something like a measured move up, a pullback where the RL10 crosses the dragon and then immediately recrosses again. And so that sets up this little pocket entry right here where the yellow dot is. That's that triangle of space right there in the yellow that is completed by the pullback of the RL10, and then it reverses and crosses back over the dragon. And then if we go to the previous hump of the RL10 or the dragon and we draw that horizontal line across, that sets the conditions for a not later than emerging dragon entry. In other words, it's what Robert Gardner used to call a candle negation. And that's a price when it takes out the previous swing high in the form of the RL10 or the dragon. What that does is negates all that negative price action that brought it down and then resumed. Well, sometimes this retracement is large enough that it causes us to exit in order to protect the gains from an entry down here at the owl at the RLXD. So when it moves up a distance and comes back, we're faced with the decision after it's crossed the RL10, do I want to exit? My normal position is, yeah, let's exit. Because if it crosses back above the dragon, then we have a pocket re-entry. Now, sometimes that doesn't even go deep enough for us to get out of the trade. And after the hesitation, we may end up deciding to add a second position inside this pocket, this little cove of quiet. Or we might just wait till it crosses above the previous swing high and make our second entry. But if we got out, then our places to re-enter would be in the pocket or on the emerging dragon. And then this little pattern should keep going up this price ladder that we've marked off. And it could be a return to yesterday's close or a Z1, Z2, Z3 extension or some support and resistance. But in every time frame, we can use various price ladders that allow us to make reasonable estimates of where price can get to. And so that's what the upside of that trade out of the owl pattern looks like. Some kind of measured move to the upside until the point where it can't go any further. And then if it doesn't fail, it may just roll into a sideways quiet channel. Similarly, on the downside, we might get this P1, that regression line crossover outside the river. That RL10 might not even get through the dragon and then just start to fail again. That's the best of all possible worlds, because that's going to set up our collapsing dragon. So a collapsing dragon we construct the same way that we construct the emerging dragon. And that is, we find the lowest excursion in the RL10. That's usually a little deeper than the dragon, because it's the regression line and not the simple moving average 10. So it's a little bit faster. and goes a little deeper. So we can draw a line across from the bottom of the RL10 where it made its pivot, and we draw that line and say that's our not later than entry to get short in the collapsing dragon. So there's two possible ways to get into this continuation play to the downside. One is we get it inside the pocket that now looks just like the mirror image of this pocket. It's created by a reversion to the mean on the RL10, but then it rolls over. And then when it crosses below this red line, that pocket is complete. So if we want to front run the collapsing dragon, we're trying to get short in here before it makes its collapse. Now, one of the things that we observe is that when it collapses below that previous support level, then quite often this move is sharp and fast, and we don't want to chase that. So on the downside especially, there's a good argument that says if you can handle it, front run that collapsing dragon with a pocket entry. We would call that a P1 failure. And by that we mean that the P1 has occurred, the 10-period regression line has crossed the 30 and started to reverse, but it failed. It failed through the red line and its collapsing dragon. And then what we notice is that quite often the second move is as big as the first move. So you have leg 1, pause, leg 2, and then when it pauses again, we might see the pattern repeat itself with an P1 and an RLXD and possibly an owl, or it may just fail in the pocket and then make another collapsing dragon. Every time I see leg 1, an unambiguous move down, I plan for leg 2. That's the trade I really want to take. That's my favorite pattern of all time. So I see 1, I plan for 2, and I hope for 3. And then if I get all 3 legs down, what really happens is that we now have one giant leg 1 on the next higher time frame. And so if we see 3 of these legs down on our time frame in a hurry, with little to no effort at resumption or reversal of the trade, then it would not be unusual to see a really large move, twice this or 3 times the size of this 3-legged move downward. And then that will go down as far as it's going to go until it eventually may become a sideways quiet channel later in the day or the week or the month or the year, depending which time frame we're trading. And so this period of directional trading movement ultimately is going to compress into a sideways quiet channel when all the trading is done and people are licking their wounds. Well, there's another thing that could happen after we get that first leg down. It may give us an owl, or it may noodle around with a P1 failure, but it doesn't really have any follow through to the upside, and yet it doesn't fail to the downside. What you'll see there is some kind of sideways choppy motion, and it ends up compressing. So all the volatility of that first move begins to leave the market. And now this thing compresses into a sideways quiet channel, 10 bars, and the slope is flat. And you'll see the Z3 lines beginning to compress. And they may compress so tightly that it becomes exceptionally tight and becomes a Z3 pinch. That's my favorite sideways quiet channel because it is abnormally pinched and abnormally sideways. And then we can play that as a critical state and a breakout move. And now we can play the Z3 pattern to the upside or the downside in the same way that at the start of the day, we began with a hybrid frog, a minimum manageable risk box, and just decided to follow the trade in whichever direction price was willing to go. So collectively, this is our chain trading battle drill. And I have described it here in terms of an intraday trade that starts with a hybrid frog. But on swing trading on any time frame, you can consider a sideways quiet channel as being the start point. Anytime that you have a critical state, what you have is essentially an abnormally small range yesterday or the previous bar, preferably the previous 10 bars, that have compressed into this sideways quiet channel, or better, a Z3 pinch. And then that becomes the basis for the beginning of the next swing move, which may take 2 or 3 legs to unfold. So the reason I spend time on this pattern is because the chain trading allows us to connect different styles of trading that are both directional, reversion to the mean, what to do in channels, what to do after measured moves. So even if you missed the measured move, the big unambiguous move, it doesn't mean it's over. It just means that that thing is in play. And it's either going to be a reversion to the mean or a continuation of the fail, or it's going to just drift sideways into a sideways quiet channel and a Z3P, and then that cycle is going to continue all over again. Because these patterns are fractal and the interpretation of the indicators are identical in every time frame, we can master one set of trading skills and trade framing architecture and have one common set of beliefs that we can execute in any time frame. And there's a certain efficiency and effectiveness in that approach. So that's what I want to say about chain trading as applied to intraday with the hybrid frog, or in a larger sense, with swing trading using sideways quiet channels, Z3Ps, owls, emerging dragons, and collapsing dragons. Those are the essences of our patterns. Okay, so that's what I want to say about that. I want to do a quick debrief of the day next. So what we had was today's price action. We had yesterday that was Friday, or I guess no, that was Thursday. Feels like so long ago. It tested a 10-day high and then sold off into a doji. So Friday, the market ended in a critical state, and we were looking for a continuation play to the upside or collapsing price ladders to the downside. And what we got instead was the beginnings of this, you guessed it, a sideways quiet channel. It opened just slightly down from the close, sold off a little bit, came back, and then just mucked around and closed right on the RL10 at the trader's price. So we had another quiet day, failure to fail, minor profit taking, and some posturing for continued success while the world continues to try to dig out of this pandemic hole. So here's the one-day trading range. The updated 10-day has a 10-day high at 282 approximately, a 10-day low of 243. Now I've marked those both off with thick lines because a breakout from a 10-day trading range, in my view, is significant for swing traders who have been trading inside this 10-day look-back time period. And you can see we've closed near the top of that. And we are still within, eyeball distance of the Monday opening. We're slightly below, which is a little negative, but we're still in pretty good shape for the upside. So the move to the upside would feature a breakout of the one-day high, the 10-day high. Then this one is what is that one? If we look back, that's the Z1, sorry. So that would be a breakout of the river. That would be the beginnings of a potential directional move, right? We would get a directional move to the upside once the RL30 comes all the way through the river. But as it stands right now, if price were to get out of the river at Z+1, that would actually be a very favorable indicator. So that's why that is labeled in thick. Now, fair value is back up here at 304.5. We have Z+1 at 310. We have a 30-day high and a thick line at 314. So I have that thick because, in my opinion, a breakout of a 30-day trading range would actually act as candle negation for all of this sell-off. That 30-day high is so close to the previous high that that would be seen as a very favorable move. So what that means is a price above that means people will have discounted all the pain and suffering that went in here. Remains to be seen if it can get there. But to get there, it has to get through the one-day high, 10-day high, Z1, long-term fair value, Z2, that's the edge of the floodplain, I should say, then a 30-day high. Then the previous swing high of the dragon and the RL10 is up here at 334. So that's the price ladder on the way up. That's the signposts or the road signs of what lies ahead. On the way down, what we have is about a one-day low, the Bollinger Band mean, Good support here at the southern skin of the dragon at 256.5. I have that as thick because that one feels significant to me. That would be a 5-day breakdown. And so to me, the bottom of the dragon is where we're fighting. It may come test the Bollinger Band mean, but it's got to hold the bottom of the dragon for this upward move to remain in effect. And if you look at this, what we have is 2 legs so far. We have leg 1, pause, leg 2. So 1-day low, Bollinger Band mean in the RL90, southern skin of the dragon. We have the 10-day low and strong support at 243 3/4. We have Z -1 at the edge of the river. We have the PSAR flip, which coincides right now with the belly of the dragon. That is absolutely important on a weekly and monthly chart. When we looked at it this weekend, we saw that that was a key price level for weekly and monthly positions. We then have the belly of the RL10 and then the ultimate swing low down here around 220. So that puts us into the context in this treacherous mountain road, this twisty, curvy road. These are the guideposts that start telling us psychological statements of support and resistance, and then those become prices that give us information. Now, what I want to say is that with conventional analysis of support and resistance, this yellow zone right here, there's no real resistance in here except the ones that we've plotted with our indicators, which are, proprietary to us or unique to us as far as I know. I don't know of anybody else that uses 30-period Bollinger Bands and the RL270 as fair value. So those are really insights that come from our methodologies. But if otherwise you look at something above the 10-day high and up to the 30-day high, there's no real clear support and resistance in this sell-off. So my opinion is that if this thing breaks out above Z1, in other words, it takes out Friday's high at 281 or 282, there's really nothing that causes it to slow down. So I would not be surprised if that was a powerful upside move. If there was any kind of buying pressure and momentum, I'm not going to allow myself to be surprised if it makes a thunder run north through here. A low probability event, but not impossible. Now, to the downside, there's plenty of support and resistance levels that you could measure over here that are shorter term in duration. And so this trading down here seems to me to be choppier in nature, because I think the plunge protection team and all of the people with long-term cash to burn, like the $6.5 trillion the Fed printed, are going to be looking to buy tests of support down here, because they do not want it to go below the belly of the dragon or the previous swing low and then reactivate all of that herd fear mentality. That was the purpose of a $6.5 trillion aid package and the promise of unlimited money from the Fed. What other purpose could there be than to prevent that kind of fear from being in effect? Everybody who's going to make money on the long side out of that crew, I believe, bought inside here and would love to see it up here by previous support levels. That's what makes them the most money, and they're driving the ship. Meanwhile, while I look down here at the MACD histogram, I see that we have ended the winter right about here, started getting tentatively long here in the spring as it entered and then departed the Red River, which is that 30-period Bollinger Band on the MACD histogram line, it's the MACD signal line. And we are now right at the transition into summer. Tomorrow will be summer unless there's some kind of unusually large gap down tomorrow. No indication of that yet. That's when we can officially pick up the long side bias. So I will tell you that would coincide. Imagine this, if it opened inside today's range and then took out today's high and then the 10-day high, and it's off and running, you would see this thing jolt into the summer, and then I would be adopting a significant long side bias and trying to get long side positions wherever I could in the leading candidates for relative strength. So that's going to be my posture going into this as I read the indications for tomorrow. Let me cover The oh yeah, let's cover this one. This is the um, all the sectors for winners and losers today. So here we have the S&P was down minus zero point 0.9. Doing worse than the market today was Euro Asia, oil and timber, clean energy, the Dow 30. So the broad S&P large caps are starting to do a little better. Home Depot, McDonald's, Wynn, materials, small caps. So this was a selling day on what had been the winners from last week. No out of control selling, but this was a pause out of people that I think were protecting the gains from the last 10 days or so. And then Caterpillar is a noticeable loser at minus 8.5. That will bear some investigation tomorrow. To the upside, better than the S&P were slightly treasuries, healthcare, Brazil, U.S. Steel, Japan, energy, Mexico, tech, silver, Alcoa, Apple, Walmart continuing to do really well. It was a late bloomer. And then Tesla and Wheaton Precious Metals, both of which I finally got on the right side of, and we're going to see those in terms of both core and turbo here shortly. So that was the winners and losers from today. While we're getting ready to transition, I should also say Danny's been working really hard on the TC2000 bundle, and we've added just today a bunch of new short videos that show how to use that bundle in its totality, the different layouts that are available with a mouse click, favorites, high and low, OWL and PSAR flips, and those are really good for intraday. Using the multiple time frames on a single screen and comparing it to the market. The fail stat and gain stat layout for intraday trading, the frog boxes, and then the hybrid frog fishing layout, which is Danny puts a bunch of symbols in that stack that are of interest, and then whichever ones trigger the hybrid frog earliest allows him to quickly see who are the early movers and then quickly scale over into those positions. So that's a pretty clever way to start the day. So we're starting to populate that TC2000 course inside the learning management system, and so there's probably 20 different lessons in there now, each one about 3 to 5 minutes long. So there's an hour and a half of some pretty good material there for the TC2000 bundle users. Let's see. Let's get to the daily if we can. Just bear with me a half a second. Be right with you. You should be able to download this from the handouts section in here today. And then it's already posted at Patreon for you. Come on, Kenneth, open the darn. Could have sworn I had that open already. And here we go. Thank you for your patience. Okay, so let's get on with it here. So we've already been through the health check. Um, so we are still in bearish normal conditions. So the cognitive dissonance right now is that I said a few minutes ago that if it opened up and went through yesterday's high or today's high and the 10-day high, that I would adopt a very bullish approach to it. And yet we're still in bearish normal. That's just part of the. You got to be able to hold two ideas in your head at one time. I'm ready to get on the winners for the long side if it added that vote of confidence, because we would now be 2/3 off the swing low, going back towards normal. It's just that move was so deep into the bear that it's still bearish. So I would be mindful of that and try to stay focused on just the clear winners. And I would still adopt a short time frame and be ready to cash winners, but I really would want to be aggressive on the long side. That's how I'm treating that. Looking at the NDX, we're now back to about the middle of the road on all of the lookbacks except the 10-period lookback, in which case we're already strongly overbought at 85. We're back in single digits of sell-off from the 200-day moving average at minus 8.4. So we're still red bearish, but we've managed to decrease the strength of the bear. His ADX is only 27.5. Still strongly bearish, but a considerably improved position. The risk index, based on volatility, comparing the 30-day and the 10-day, is in the positive territory, and it is suggesting risk on, with a risk index reading of 1.177, and that has a risk z-score of 1.6. So it is abnormally favorable for the long side swing. So when I put all of those pieces together into the market mosaic, I am cautiously optimistic about the long side, and I will aggressively exploit intraday long side trades with a view towards preserving some of that position with markets money. So if I bought 1,000 shares of something intraday and it was closing well, then I would look to keep 100 or 200 shares. In other words, keep 10 or 20% of that position and pay for that risk capital with the gains that the 1,000 shares had made. So I'm trading core and turbo in that technique. Okay. The S&P is showing as a overreaction signal short, and what that means is that the rebound has been so sharp that, in fact, under normal times you could interpret that as a dead cat bounce. But consistent with what I just said, abnormal times call for abnormal approaches, and so I'm not going to be shorting it automatically, as the overreaction system would suggest, but I'm going to wait to actually see price action to tell me which way to go tomorrow. I still consider us to be in a critical state with a larger than usual chance of a larger than normal move possible in either direction. You can see the 10-day max pain candidates are really the same guys that have been smashed over the last 30 days. The 10-day min pain candidates are the ones that have lost the least from their 10-day high. So that's, you could consider them to be strong defensive plays like Walmart, IBM, Pfizer, Verizon, and AT&T. The symbols getting smashed include Caterpillar, today down almost 9%, Boeing, ExxonMobil, Walgreens, and American Express. So those are from those extreme conditions, you can often get extreme follow through. So they'll be on my short list to prepare. In the tactical summary for the Dow, nothing tests out on the auto framer. Plenty of dojis fired today. And you can see that nothing violated the RSI2 column. So nothing is in single digits. So everything has pretty much been healthy on the rebound, with the exception today of Caterpillar down 8.7, and then Morgan, Coke, and American Express all down more than 4%. The winners on the day, Intel, Walmart, Apple, and Procter. All other things being equal, I would consider that to be a strong vote to the upside. Only Apple broke out to a new 10-day high with a score of 109 on the 10-day NDX. So to me, it looks like Apple is on sale. and has some momentum. In the ETFs, we had Japan and Treasuries both test out well on the auto framer. That's good. We had gold broke out to a new 10-day, 1 month, 3 month, and 6 month high at 161.41. And then technology, the Qs, also broke out. So technology had been lagging behind the other components of the Dow and the S&P. And so maybe this plus Apple are some indications that we're reverting back towards a technology-led rebound. Yeah, a handful of dojis, lots of things trigger on the OR overreaction short. So these are all symbols that if we had a sell-off day tomorrow would be high on my priority list to get short. The daily pinch and stretch, the symbols in column 1 are the ones that are out of the river and to the upside. You can see gold and Walmart are already past the floodplain with z-scores beyond 2. And then column 2 shows the ones that are in the lowest level of their river. So oil is worse, but that's only at minus 0.91. So that's still inside the river. There was a time when that number was 8 sigma to the downside. That's how sharp and deep that sell-off has occurred. So obviously a lot of healing has occurred. The most expanded pinch box in column 3, these are the ones that have the most directional move and the widest river out of the past 30 days. And so Caterpillar, Coke, real estate, and Walmart all have had the widest and most directional swing moves. And then the most compressed pinch boxes are the ones that are the narrowest rivers or showing the least directional volatility. And then these could be poised for additional breakouts. I would be really keying in on Microsoft and Cisco, which have been strong leaders and with lack of volatility may actually be poised for an upside move. In the only a handful of symbols test out better than 2-to-1 on the retest of the 10-day high. This gives you the framing data, gives you the mechanical entries and stops. The regression line fractal framework, the top shelf are the ones that are the deepest value plays. And so Boeing, you read this, is 5.4 ATRs below its long-term fair value. Mexico is 7.13 ATRs below its long-term fair value. So that's a candidate for get short on weakness or get long on intraday strength because you're buying quality on sale. In the bottom shelf in the red, these are the relative strength leaders. These are the ones that are above their RL270 for fair value. Or the closest ones to it. All of these are still below their long-term fair value, but they're closer to it than the laggards in the top shelf. Daily squeezes are the ones that had a relatively tight range today compared to the size of their average range. So these are candidates for one-day directional pops. In other words, it opens inside yesterday's range, takes out the high or the low of today, and then if it just moves an average range, it's going to have a really nice payoff, as you can see in the highlighted green column. Those are the reward to risk multiples inside these. Of interest are treasuries, Microsoft near the top, Japan, Home Depot, Cisco, and XLK Technology. All of those are very interesting to me for that reason. In the Four Seasons, you can see that we've started to get a considerable number of things across their zero line, so we can have a long side bias on those that are in the summer. And I would be looking for those in the spring that have the highest Z-score as being the next candidates to cross the line into the summer. So the ones at the bottom of the stack, they're healthcare, technology, and then Walmart, Johnson Johnson, Pfizer. Those are the ones that are showing the greatest amount of resilience and relative strength on swing time frames. So those are the easy ones to believe in terms of momentum for swing traders. The NDX multi-time frame, NDX summary, just shows us where things are inside their look-back periods. So these are we look at 3 days, 10 days, 30 days, 90 days, and 270 days. We set that equal to 0 to 100 between the lowest low and the highest high. So when you see Apple has broken out above 100 on the 3 and 10 day, that means it closed at a new 3-day high and a new 10-day high and left that trading range behind. Similarly, gold had a breakout on every time frame that we look at from 3 days all the way back to 270. Now I sort this by the 10-day column because I'm interested in swing trades as the centerpiece of the beginning of my trading strategy, and I like to know which ones are strong or weak on the basis of their 10-day trading range. So all the ones at the top are the ones that are the weakest compared to their 10-day look back period. So Caterpillar at 37 is the lone wolf inside the Dow 30. Everything else is looking pretty healthy, is above the 50-yard line, but only Caterpillar got smashed today. And you can see with the minus 81, it made a significant 3-day low. So we can be sure that when we look at Caterpillar, there's going to be an extraordinary chart to look at. So that's how we use that chart. The remainder of these are part of the market mosaic that help give us insights into market classification. Chart 1 shows a favorable 30-day regression line trend developing where it's getting healthy. And that chart 2 shows that the slope of that regression line in its long-term historical context. It made a crossover over its 10-period moving average, about 15 days ago, and that was an indication that this just might have been a swing low, and so far, so good. So we'll see how that goes. The remainder of these are just for references only. I will say on the z-scores of the regression line slopes that the 30 has recovered, the 90 is starting to roll over and roll up, and the 10 is showing a lot of strength. We've come all the way back from the brink of disaster and managed to cross a very wide river. We had held support at the southern shore and now is approaching the breakout above the river. And that would be significant in my view. That's everything that I want to cover for today's report. And now we'll take a quick shift and look at just a handful of intraday charts today. I'll go through this pretty quick because we're already 40 minutes into the briefing so far. Okay, so here we go. So this one is SCO. This is an ultra short in oil. So we're now on 1-minute charts intraday, about 15 or 20 minutes in. I've seen a low of the RL10 and a high of the RL10. I've drawn my little manageable risk box. And the yellow dot means I was considering getting short there. I did not. I had other things to do, but I considered getting short there. And then as it sold off, immediately regretted why I didn't get short, because I sure missed that trade. And then it moved all the way down to inside that blue circle. You see it was pushing the boundary of Z3. So that was a really good move that if I had taken in a normal way with a hybrid frog, would have paid off. And that's an unambiguous move to the downside. And then about a bar later, we have the P1 where the RL10 crosses the RL30. And very quickly, the RL10 crosses the dragon. So now I actually buy that on the RLXD, which is the third criteria in the owl. So I'm front running the owl when I do that. And I put a stop at the belly of the dragon. That thing is working. It's working. You see the PSAR flip has occurred. That's positive. Price tested the Bollinger Band mean. White knuckled it a little bit, but it resumed its upward move. The PSAR was never threatened. The bottom of the dragon was never threatened. It got all the way to Z plus 2. Now the RL10 is rolled over. Now at this point, I'm looking to preserve. Where I'm thinking about now is thinking about preserving my profits inside here because of the proximity to the VWAP. That's where I would be stalking the exit at this point. It holds support, breathing a sigh of relief, and then it fails. It held the Bollinger Band mean. I got no business being in this trade. But a good thing happened to a bad person. This is bad form. I should have been, I give myself a C- on this trade. I should have been out. I could have been out here and cashed a highly successful move here, that exit would have been better than any exit in the next 20 bars. So that's why this is a poor exit strategy. Now there's a P1, a violation of the Dragon and the VWAP, a violation of the Bollinger Band mean. This was my last chance to get a passing grade on this trade. I did not exit. I lucked into this one with a second entry when it made a double bottom here with the RL10 and the Dragon rolls up. I should have been exiting here and then re-entering here. So this is a D trade management. Absolutely horrible. I apologize for leading you astray. But the second position works. And this time I learned my lesson and showed that I'm capable of learning. This time the excursion went all the way to the RL270, made a Z3 excursion, and then I cashed it here above the previous noise level. I was not going to let this one get away and on a double size position. So that was bad form, but luck. Now at this point, I'm considering getting short in here on a, this would be like a pocket entry short. The PSAR flipped happened. I would not be offended if you got short at this point with a target of the VWAP and then a retest of the previous support levels. I would not be offended by here. But at this point, I was so overcome with relief and emotion, I did not have the ability to get short. Plus, at this time, we were already in that conference call on Zoom, so thankfully I could do no more harm. I was considering getting short here in a collapsing Dragon, and I didn't because I was still on that conference call. And I would be concerned about getting short right at the VWAP. But if I was ever going to get short, it would have to be north of the VWAP so I could be short on the other side of fair value and trying to play for a move back. And I'm trying to see a price to come down into here. So that was the second place I considered getting short. I did not. And that was the rest of that day. I just marked this one up to good fortune and bad trade management. So as bad as this exit management was, that second position was excellent. And this exit here was exceptional. And then good judgment on my part not to try to trade while I was on a phone call. So a lot to learn from that one. Even the bad examples can serve as things not to do, right? So here we are. This is now Wheaton Precious Metals. Let me get my little indicator. Oh, sorry about that. Didn't mean to do that. Just trying to draw my cursor here. Okay. All right, so here we are in Wheaton Precious Metals. Wheaton Precious Metals, we're in a swing trade on this one already with a couple positions in, and upside movement is the direction of that swing. So it opens inside a relatively tight range, sells off a little bit. Now we're 30 days, sorry. We're 20 bars into the morning session. I see the fair value starting to roll down, the VWAP starting to roll down. I noticed that we went from fall into the winter, so this is a place to have a short side bias. I'm not worried about this on my swing trade because I have the stops on that already built in to that position to protect it against the normal moves of a swing time frame. So I'm just stalking this one for intraday, and I'm really looking to add positions here to get long if it should turn around. At this point, it has now gone from winter into the spring. You can see the MACD histogram has started to roll up. So this is where I can now become cautiously optimistic. I see the PSAR has flipped. I see the RL10 has bottomed out, the P1, and now an RLXD. That's the third criteria. So that's where in my habit now, intraday, has been to enter if I'm being an active trader. So I'm long here with a stop at the PSAR, at that black PSAR dot, okay? And I'm targeting, I am targeting the VWAP This I wanted to show this right here so you can see the price, but the red dot is actually where it hits the PSAR, but I did not want to obscure that. I wanted you to see that unlike the other trade in SCO, this one was properly executed. So the exit here, when it came through the dragon, I did not want to let this thing go negative, so I just exited there. 4 bars later, it has recovered. The PSAR is intact. The RL10 is rolled up. Everything has crossed the dragon and the VWAP, so I just habitually get long again. My mind has changed, and now the long side has resumed. And notice that there was a Z3 pinch, and now it's beginning to show upside volatility. I now draw lines across from the Z3 excursions and say these now become upside targets. If it can get above that blue line, then this will be a positive vote towards the upside. It doesn't, so I just exit properly at the RLXD, and you notice the PSAR flip. So that's a little fractional gain that feels pretty good. It turns out to be the size of an execution gain and an execution gain. So I was able to preserve the initial execution risk. So that's a fractional win. I'm not afraid of that. Sideways quiet channel is developing. Notice the Z3 lines have pinched, and I've highlighted in yellow. The size of this yellow box is even smaller than the size of this yellow box. So we're getting a significant pinch. Now I'm ready for a breakout to the upside. In a perfect world, it would break out of here. I could get long, and then if it breaks above the blue line, I'll instantly add a second position because that will have confirmed a new psychologically important level for me. There's the first entry up, and that PSAR flip is my risk. And now when I look down here, you can see that we went into the fall, found support at the 0 line, and it went summer, fall, and then right back into summer. And as those of you that know from the MACD patterns, that's an instant long. Now it breaks through the blue line. I got my second position in, and I've got a comfortable profit in hand. I'm not going to lose any money on this trade. That's an important psychological moment. Now it's a science project. Managing. At this point, the phone conversation worked. It started, so right about 11:45, I stopped. I just put that one in place and then trailed it with that much and let it go. And this one, my stop had locked in. So what I want you to notice is that the first position was a scratch. The second one was a fractional win. And then this one has an entry at about 32.15 on a 15-cent risk. And we've locked in 32.75. So we've locked in 60 cents on a 15-cent risk on the first position, and that's 4 execution R. And then the second position has locked in 15 or 30 cents, so that's another couple. So that's about 6 R in hand for execution risk, and that equates to about anywhere from 4 to 6 daily R's in terms of position sizing, I should say. Okay, or I'm sorry, 2 to 3 position sizing R's, depending on how tightly you play that. Now this is at 32.75. This thing closed at 34. So there's another $1 to the upside. In other words, another upside move that if you were just to add from the first red line to the second red line, that's how much further up this goes without any look back. And because I was on the phone call, I didn't get a third position in, so I'm going to send a bill to the Tharp Institute for services rendered. Not really, just kidding. I want to shift now to the Aussie dollar. So this is a swing trade, and damn it, I did that again. Sorry. All right, so this one is a swing trade. This back here in at the end of February, we had been short one and covered on a Z3 excursion that started to reverse. Then I was slow to get into a collapsing dragon, but to be fair, I'm not primarily, I'm just dabbling in currencies. But I get short on a collapsing dragon there and cover this thing happily 3 days later after a Z4 excursion that then opened and started to recover. I just said, I gave it one Z and just cashed it here for a pretty nice trade. That was about looks like about 8 cents. I then get long on a 1, 2, 3 entry with a stop down here below the belly of the dragon. That thing pays off, and I exit here on a rejection of the Bollinger Band mean. I just take this exit, I stop and reverse because it's currencies. Why not? Cover here when it comes through the dragon and showed signs of resuming. So I get long. And this thing turns into a pretty nice swing trade where we are right now, where I have 1, 2, 3, 4, added a 5th position today. All of this paid for with markets money and my current stop right here. And because it's currencies, I'm not worried about gaps. So I have really locked in all of those moves on a five size position paid for with markets money. So that's Aussie dollar on a swing trade. Here is Tesla on a swing trade. I remember this time, yes. So here's our cursor. So just a little context on this one. I was on the wrong side of this thing consistently. I was short and covered, and got fractions out of this. Was so just disgusted that I couldn't figure out how to do it, that I missed this move. I finally got long here out of disgust, and then managed to take a loss on it, reinforce my negative self-concept. Got short, lost a fraction on that one, reinforcing my negative self-concept. Stayed with it, got long, finally cashed a winner, and that was on a Friday, and I didn't want to carry it overnight. And then Monday last week it opened, Friday it opened, so it got long. And then today we ended up getting a second position in at the open and taken off, and then it closed well. And so what I've got to do is raise my stop on this one from here to put it about halfway up today's stack in order to protect both of those swing trade positions. So I finally feel like I got on the correct alignment with Tesla. So this is Tesla with the turbo trade intraday. So I already had a long bias on this one because of the swing trade. So we're about half an hour into it. On a better day, when I see this high and that low, I would treat this as the minimum manageable risk box, and then I should be buying the breakout like right here. That's where I should be buying it. If I had done that, I inevitably would have gotten out of it somewhere in here for a fractional win or a scratch. I didn't do that. I noticed a sideways quiet channel developing with that little Z3 pinch. The first urge was to the upside. So this is feeling like a long. It makes the Z3 breakout here. So I put my stop down here like it's Z3. So that's my risk at the yellow dot. I would not be offended if you took the exit right there. I was preparing for that, and I was actually right at the end of that stupid phone call. Not stupid phone call. But if you get out here, you got to get back in there according to the same rules. I didn't do either, so I just got lucky. It moves into a sideways quiet channel again. I added position on the Z3 breakout. Another Z3 pinch. Now, I would not be offended at 2:30 in the afternoon if you exited there. If you did, you have to re-enter probably around there. So I get 3 positions in, and then we're close to the end of the day. We're in the last hour. I just terminate the turbo portion of this trade on 3 good positions. And the first one we got in looks like around 608 with about a $10 risk, and it exited at 645. So that's about 40, call it $35 on a $10 risk. So that's about 3.5 execution. That's probably additional 1, and that one looks like a scratch. So that's probably 4 to 5 intraday execution hours on Tesla. And I finally feel like I got back in alignment with it. This is Wheaton Precious Metals on the swing trade. So these are all daily charts. The initial, for context, the initial trade we had was long and then cash on a rejection of the dragon. So we cashed a winner in Wheaton just in time to miss the big sell-off, which we could not understand at the time. I still don't understand, but fortunately I don't have to. Now I'm stalking. When I notice this has moved up and the dragon has turned and the RL30 is about getting ready to turn, I now feel that all of this in the yellow is like support levels. And I highlighted it just to make sure I could see it. It mucks around a little bit, fails to fail. So I get long on a daily play here on a upward sloping dragon. The RL10 is rolled up, took out the previous day's high, so I'm long there. Second position long, and then today was a runaway move to the upside, and we traded it turbo, and that paid for 2 additional swing positions. So now I've got 4 positions, a 4-position swing trade, all paid for with market's money, and a stop at a position that will make a nice payoff if this thing suffers and dies. Okay, so that's the Wheaton the Wheaton trade there. Let me see if I thought I had a daily chart on that one, but the daily chart on Wheaton, if it will show, yeah, the daily chart on Wheaton, you can see here that these 2 thick green lines are the places where, from the swing trade pattern, let me try to shrink that up a little bit so you can see. Yeah, those are the places where the 2 swing trades were added. And then my stop that I'm carrying would be right here. So if ideally it opens above that, and then if it sells off, I'm all out at the red line. But otherwise I'm in 4 positions on the swing. So that turned out to go pretty nicely once it broke above. I just want you to notice, once it breaks out above those Z3 excursions, you start getting a sense of directionality that can be pretty powerful. So that was Wheaton, and I think that's everything I wanted to cover for tonight. That's we're an hour into this thing. So pending your questions, that's everything I wanted to cover. Afterwards, I'm going to see if I can't get that the portfolio speed run going, and then I'll get that posted. This video I'll post on Patreon and on YouTube for you guys as soon as I can. It should be within the hour. If this new software works, it'll be even quicker than that. So pending any questions, that's all I got. You guys stay safe out there. Keep your risk measured and your powder dry.